Let's get to Bruce's first top pick, and it's Airbus, the arch rival to Boeing. Is that partly because you think Boeing has so much of a repair job on its reputation?
Yeah. And I just thought I'd start talking about our big holdings, Meta, Facebook, and Microsoft, that probably a lot of people are talking about. We talked about some more interesting ones. So Airbus has a backlog that they've sold planes out a decade from now that are, waiting delivery. Short term, though, they're still having supply issues, and some of these supply issues are related to Boeing. But airplanes obviously are making 10 a week or something, so they have a lot of little suppliers that supply one component and this component, and they all have to be certified by the FAA and all this sort of stuff. So anyway, so the component supplier is supplying you with 10 components. He's supplying BMW with 100,000 a week. Who's going to get first call? So even though this is a prestige business, so it's been down on that, but you're in a duopoly. Your main competitor is facing huge issues, and they're getting two businesses of Spirit for free. In this Spirit takeover by Boeing, they're getting the Belfast, North Ireland business, and they're getting some American businesses that actually were supplying some components to Airbus. And so I just think Airbus is a solid play. It's about 20 times earnings, and the earnings are a bit depressed because of this, and you've got solid growth out over the next decade. Also, the defense businesses in Europe are going to do well. They own the largest helicopter manufacturer and things like that. So I think it's just a very easy, solid play.
Okay, Air Canada. Now, we just heard that there's a big short position in Air Canada, but you're more optimistic?
I mean, last time Air Canada's balance sheet looked like this, the stock was $50. And demand, there's 10% more people in Canada. Everybody I talk to wants to travel globally after the pandemic. And so, I mean, demand's up, the balance sheet's better. Everything's good, and it's at 4 times earnings or 3 times earnings, or what? It's just dirt cheap. And I was a guy that lost a job saying, Air Canada's a piece of junk 20 years ago, 30 years ago.
That incredibly low multiple, but I guess these cyclicals, you often buy them when the multiple's high because the earnings are depressed. Yeah,
and if you go back, I mean, the railways used to be a non-touch industry because they were government-owned and inefficient. Anyway, the airline industry's been going through that. Like, the governments are pretty well out of the airline business globally now. They're going to run better as better businesses, and the markets still haven't accepted that. But
okay.
So, I mean, this is a home run if we hit it.
Okay. And then Evertz Technologies, a maker of broadcast equipment.
Yeah, and I expect someplace between my voice and your listeners' ear, there's some Evertz equipment along the line. And Evertz stock's down on, they're moving their business to SaaS, which is software as a service. So instead of making the big sale up front, they give you the sale for pay them every month for instead of paying them $100 up front, you pay them $10 a month, and it's probably a better business, but it's going to hurt their profitability in the short term. The company though continues to generate cash. It's got no debt. And it pays over the years, every time it gets to $100 million of cash in its balance sheet, pays the dividend of $1, an extra of $1. That's yielding 6.5%, I think, right? 6.2, you've got it up there. And you're likely going to get another dividend of $1. It's a $12 stock, and it's bounced between 12 and 17 over the years. And they may make an acquisition. If they do, it'll be brilliant because they keep failing because they won't pay enough on the acquisition. So if they get one, it'll be at a good price.
That's interesting, though. They're just wary. They don't want to overpay.
No, the two main owners each own 37 or 38% of the company. So you're going on their call, and they're not going to make a bad call and cost themselves money.
That's interesting. They're not going to just get caught up in the euphoria of a takeover deal.
Yeah.
Number one idea, Alamos Gold, AGI. And you've told us you do like the look of the gold sector.
I do a lot. And by the way, I'm just going to step one very quickly back and say Eric Nuttall is coming on tomorrow. He's a person I have lots of time for, so tune in tomorrow. You'll like his what he has to say. Alamos is a superb gold company, Canadian, and therefore it's politically safe. They have this ability to keep expanding their high quality reserves, and for gold companies, trying to get more reserves is very, very difficult. So when you got a company that keeps doing it, you got to say, hey. Plus, I think they're very, very well managed. So it's a nice win. Technically, the stock has just broken out on our work. I think that the golds have a long way to go, and this one and probably Agnico Eagle would be my two favorite stocks.
And just very quickly, Ross, why are you keen on gold? Why are you bullish on gold?
Well, let's go way back to how I started out and where we are in the black hole condition here. I think if we think that inflation is going to go away, we are grossly and sadly mistaken. It may in a very, very short term, but that's not the condition that we're in. We have weakened the U.S. balance sheet horribly. And the only thing that can balance that off tends to be precious metals.
Okay. Peyto Exploration, a natural gas specialist?
Yes. I like Peyto a lot. First of all, it's got a very nice, very well covered dividend. Mm-hmm. And I like that. So you're being well paid to wait. Right. Now, what's the stock doing? It's because it's going sideways now for some period of time. Why has that happened? Well, in the COVID energy meltdown, Peyto really dived, and because I guess they thought it would go to business, and from the bottom it went up 10 times. Well, but it only got back up to its book value. Mm-hmm. So the stock remains historically quite cheap. Nice dividend, cheap, and in an area which, as I say, well, listen to Eric Nuttall tomorrow, but in an area which I think will do well.
And then finally, BCE, it's the parent of this network.
Yes.
And like other telecoms, it's dropped a lot.
It has. I mean, it's come down from $74, I think, down to, it's about 44 now. It may have some modest risk to around maybe $40, but first of all, it's got an awfully nice dividend, and secondly, it has nice upside potential, and thirdly, whenever you get a good quality company like this, and I think it's one of those companies that they call a dividend aristocrat. I believe, and of course, they just raised their dividend just recently. So, hammered badly, cheap, nice dividend. It's the kind of stock which, when everybody's going to look around like, what should I buy? Oh, well, look at, there's BCE with a 9% dividend being well hammered. It could have a really nice pop. Mm-hmm.
RBC says that investors want to see an end to what RBC calls competition in cellular right now.
Oh, well, I mean, is the industry out of the woods? No, of course not. Competition is fierce, but of course we see this most blatantly in BCE because of that. Although TELUS has had a fair setback as well. TELUS has got a bit more to go. BC might go down a little bit lower, but if there's ever a time to get into BCE and kind of roll the dice, I would have to say this strikes me as being the time.
Time now for top picks from Eric Nuttall. Number one, we've talked about it a bit already. Eric will elaborate briefly, I think, on this one. Baytex Energy, ticker symbol BTE in Toronto.
Baytex has been a long-term holding, and it's been a long-time laggard. It's disappointing. We're sticking with it because we see a profound value disconnect between where the stock is and where we think it should be. You're getting 13 years of stay-flat inventory and high-graded Eagle Ford acreage and some other assets. Over the next 5 years at $80 oil, we have them buying back 95% of their current market cap. So they're basically gone in 5 years. They've got 13 years of free cash flow inventory. We look at a stock trading at 2.4 times, a 27% free cash flow yield at an oil price $3 lower than where we trade. That's a disconnect. I think there was a misunderstanding in terms of their lack of share buybacks earlier this year, saying, look, they're not doing it. They issued all the stock. They don't see the valuation proposition, so why should we, et cetera. Q1 for them was a very heavy spend. They've spent the money. Now they've got the production. They've got the free cash flow to harvest. They bought back aggressively in June. We have over the next 6 months, basically from now and the year end, they're going to buy back 10% of their shares outstanding out of free cash flow, and that's only with half of the free cash flow using the other to continue to delever. So we say this company should trade at a 12% free cash flow yield. That's only a 4 times multiple. That's about a double from here, $9.93. So we're sticking with it. I know it's been very, very frustrating. We just think that there's a lot of inefficiencies in the SMIDs, not enough people looking there, but it's the buybacks. It's buying back 10% of your stock over the next 6 months, which should set itself up to outperform.
You've used that word SMIDs a couple times. That's not
small and mid-cap stocks.
Okay. New Vista Energy, number 2 today, NVA on the TSX.
NuVista is a very clean story. It has some of the highest quality Montney acreage, so they've with very condensate, so think of it as like oily natural gas exposure. They're growing production by about 50%. They're going to grow production from 85,000 BOEs a day to about 120. Once they reach 120, they have enough inventory to stay flat for 20 to 25 years. It trades today at a 15% forward free cash flow yield. We're getting 75% of that free cash flow. Once they reach that plateau level, we expect to get all of the free cash flow, which would be about a 22% yield. And so you have a company which, we're getting 10%-ish right now in buybacks, at least in 2025 at a slightly higher natural gas price. And starting in roughly 2027, at the current share price, they could privatize with 5 years out of free cash flow, but they've got 25 years of inventory. So we think this name should trade at a 10% free cash flow yield, as small and mid-cap stocks should. That's a 5 multiple. We get about a $22.50 target price, which is about 63% upside from here.
Okay, and we'll round things out today with Precision Drilling, the giant of the oil field services sector here in Canada, PD in Toronto. Eric?
So it's funny you say that. It is the giant, but it's got a modest market cap, which is why it's trading at the valuation that it is. It's not big enough for U.S. investors to kind of be able to accumulate a large enough position. This year is kind of baseline. Natural gas prices in the toilet. Oil is high, but companies aren't really drilling aggressively. So we've got it trading at about a 22 to 23% free cash flow yield today. So that's at very modest activity levels. Their U.S. rig count's fallen from over 500 to 479. Precision offers strong optionality to better activity levels in 2025. Predicated on a higher natural gas price once the U.S. requires that supply to feed their LNG terminals, plus LNG Canada as well, and shale companies having to replace their inventory of wells that they had drilled, called DUCs, drilled uncompleted wells. So it's kind of a name where, under a base case, worst-ish case scenario, you're paying 3.5 times EBITDA on a 22% free cash flow yield. Looking at 2025, as they continue to buy back shares, we're getting roughly 30% of that free cash flow. It's trading at a forward free cash flow yield of 26%. So you got a company where you've got steel, it's rigs. They last 20 years with maintenance capital. And again, this whole privatization notion, theoretically, if the share price doesn't go up a lot, which we think it will, they could privatize in 4. So we think a 13% free cash flow yield is fair. That's kind of one of these. That's a 5 multiple. That's a $191 share price a year out. That's 104% upside. So there's very little interest in mid-caps. Right now, there's no interest in services. Services and mid-cap Canadian oil names, that's where the best value proposition is, and that's where we have our clients' money.
Welcome back. It's time now for Stan Wong's top picks. Number 1 on this day, Lennox International, ticker symbol LII in New York.
Thanks, Paul. I think sometimes the most simplest businesses can be the best companies to invest in. Obviously, Lennox International manufactures and distributes heating, ventilating, air conditioning, and refrigeration, HVAC, are products to replacement and new construction markets. Replacement sales represents about 75% of the sales, and obviously new construction is 25%. And 2/3 of sales comes from residential HVAC units. 90% of the revenues comes from the US, so there's not a lot of volatility with foreign markets and geopolitical issues or anything like that. Lennox obviously has very strong brand recognition and a very extensive distribution network. They have other names within Lennox, but Lennox is obviously the umbrella top name and the high quality name. If you think about the favorable industry trends, greater demand for energy efficiency, greater demand for environmental units, environmental friendly units for residential and commercial HVAC. That's driving demand for companies like products from companies like Lennox, and then of course you have aging infrastructure, increasing urbanization, and rising global temperatures. That's also impacting the demand for these units. I replaced an air conditioner a couple of years ago, and it's a completely different technology. They can't replace the Freon, I think is what they said, for environmental reasons, so you need a brand new unit. So that's happening out there. When you look at the shares have been trending higher since mid-2022, clear channel of up higher highs and higher lows. And we see about 15 to 17% earnings per share growth forecasted for this name over the next few years.
Okay. Lennox, or LII, the company based on Dave Lennox, I believe, was the figure in the advertising. Okay, let's go to Netflix, NFLX on the NASDAQ, a very, very high-profile stock.
It's interesting. I was thinking about top picks over the last couple of nights, and I realized Netflix, although we've held it for a long time, I've never actually introduced it as a top pick. So here I am introducing it as a top pick today. They're up to 260 billion global subscribers. So clearly they're winning the streaming space, because we obviously know that Disney Plus has had its issues, and names like Paramount is a little bit behind in terms of what they're doing. We're seeing about $39 billion in projected fiscal 2024 revenue for Netflix, new high, of course. And they continue to dominate the subscription streaming service industry. Their focus on original content production and also live sports now, which is a new thing, has allowed it to really differentiate itself from other streaming services. And they're really building a really loyal global customer base that really enjoys their shows and films. They're obviously expanding their footprint into the emerging markets, which is tapping into a very significant source of potentially more subscribers. And they've introduced advertising supported subscriptions, which offers additional revenue stream, attracts some of the customers or consumers that want to be a bit more cost conscious, and they're obviously attracting advertisers that want to be advertising on Netflix. Of course, since early 2022, clear uptrend channel for this name, higher highs, higher lows. It looks like it's about to break out above its 2021, late 2021 highs, which is significant because we've seen other names like Amazon break above those highs. If it breaks above that, that means sky's the limit at that point, figuratively speaking. We see about 30% plus earnings per share growth going forward for this name. And it's actually only trading around 1x PEG ratio, PE to growth, which when you look at this name relative to other communications and tech names, that's actually fairly inexpensive.
Okay, Netflix is number 2, and the final top pick on this day, Novo Nordisk, another high-profile stock, the maker, of course, of a drug that gets used for weight loss purposes in addition to diabetes, NVO in New York, and there's the one-year history of that stock.
Yeah, I really like this name. It's obviously now Europe's most valuable listed company. It has a dominant position in the growing diabetes and obesity treatment markets. It supplies half the world's insulin. It commands about 1/3 of the diabetes treatment market now. 40 million people use drugs from Novo Nordisk. We've just seen unprecedented growth driven by consumer demand for blockbuster medications like Ozempic, which is for diabetes, and Wegovy for weight loss. And then now we're seeing some promising other benefits, health benefits, like cardiovascular, liver, and kidney benefits from taking some of these drugs from Novo Nordisk. It's been outpacing the broader MSCI or S&P 500 market since early 2017. Strong upward trend, so technically speaking, very, very strong. And you look long-term, like the global demographic trends are clear. We're seeing rising obesity rates around the world and also an aging population. We're seeing about a 25% earnings per share growth rate from this name, so another growth name.
Welcome back. It's time now for Javid Mirza's top picks. Number one on this day, we did touch on the grocery sector in one of our question and answer sessions with Javid. Metro, ticker symbol MRU, one of the big three publicly traded grocers. Javid?
Perfect. Thanks, Paul. So what I would allude to is our market cycle model work is a big driver of what we do. And for all those listeners out there, one little tidbit I would give you is that it's best to own the worst performing stock in the strongest sector than the best performing stock in the worst sector. And what we think is coming up on the horizon is phase 3, which starts to get close to the market peak, and then phase 4 is when the market starts to come under pressure and break down. So the reason I'm mentioning this is you can see here 2020 and then through 2021, and then as we got into the market peak, that's when Metro started to outperform. And so what's happened here is quite important, is we are just breaking out to new highs here. That's really positive from a technical perspective, but importantly, in terms of positioning, we think that groceries and staples are going to be a place to hide as we get into the market peak, which we think is coming in the next 6 to 9 months. So really like Metro here, and the technicals are quite strong.
Okay. Number two on this day, Hydro One, ticker symbol H.
Yeah, so
on the TSX. Go ahead.
Sorry, Paul. I got to jump the gun, got a little bit excited here. So really love this chart. That's one of the reasons I'm so excited on this name. Poised to break out to new highs here. And what we're seeing here develop is something that we really like in the technical space, and it's a bit of an ascending triangle pattern. You can see the base up top here and the higher lows. That's because investors are bidding up the price each time. And this looks like it wants to break out to new highs here. This is another positive name. And I think the headwind of rate hikes is at least alleviated for, call it, the next 6 to 9 months. So some of these more rate-sensitive plays, that should be a tailwind for them. But also, as we're looking ahead, we want to add some more defensive names, and Hydro One really fits that bill. So boring, defensive, making new highs, we love it.
Okay, and number three on this day, and I believe this one is related to the grocery sector, Choice Properties REIT, CHP.UN on the TSX. This is the REIT that I believe owns Loblaw's properties, correct? It rents real estate to Loblaw, is that correct?
Paul, you nailed it. And that's actually part of our thinking here is, first of all, we're seeing REITs rally here, really like the setup, and this name is starting to push up. Now, we're seeing a lot of the other names in the REIT space turn up here, like the apartment REITs, so Canadian Apartment REIT, InterRent. And right now, this name looks like it wants to push higher here. Really like the setup. You're getting it towards the bottom of this trading range. And as we alluded to, I think, with rate hikes at least off the table for now, this should be a pretty good defensive play to sit back and collect some yield. And it looks like it wants to push higher here. So this is another name that we really like. And we think REITs and financials are going to have a catch-up trade into the end of the year.